Most investors spend their time searching for the next quick profit. They buy stocks based on tips, sell at the first sign of trouble, and wonder why they never build lasting wealth. But what if the real path to uncommon profits is not about trading more, but about finding extraordinary companies and holding them for decades? In Common Stocks and Uncommon Profits, Philip Fisher presents a revolutionary investment philosophy that changed the way the world thinks about growth stocks. Published in 1958, this book became one of the most influential investment guides ever written. Warren Buffett himself has said that he is 15% Fisher and 85% Benjamin Graham. Fisher's approach is simple but powerful. Find exceptional businesses with strong growth potential, buy them at reasonable prices, and hold them for the long term. Let us explore the core principles that make Fisher's strategy so effective. Fisher begins with a fundamental question. How do you identify a company that is truly worth owning for years or even decades? Most investors rely on financial statements and price charts. Fisher argues that these tools are not enough. To find uncommon profits, you must understand the business at a deeper level. This is where Fisher introduces his famous 15-point checklist. This checklist is a systematic framework for evaluating any company. It focuses on qualitative factors that determine long-term success. The 15 points cover three main areas: growth potential, competitive strength, and management quality. Let us examine the first set of points, which focus on growth and products. Point 1 asks whether the company has products or services with sufficient market potential to make possible a sizable increase in sales for at least several years. Fisher wants companies that can grow significantly, not businesses that are already mature. Point 2 examines whether management is determined to continue developing new products or processes. Innovation must be part of the company's DNA. Point 3 looks at research and development effectiveness. It is not enough to spend money on research. The company must produce actual results from those investments. Point 4 addresses sales organization. Does the company have an above-average sales team? Even the best product will fail without effective distribution and marketing. Point 5 considers profit margins. Does the company have a worthwhile profit margin? High margins indicate pricing power and efficiency. The next set of points examines how the company maintains and improves its position. Point 6 asks what the company is doing to maintain or improve profit margins. Markets change constantly. A company must adapt to protect its profitability. Point 7 looks at labor and personnel relations. Does the company have outstanding labor relations? Happy, productive employees create better products and services. Point 8 examines executive relations. Does the company have outstanding executive relationships? A strong management team that works well together is essential. Point 9 considers depth in management. Can the company operate effectively if key executives are unavailable? The final points address financial and shareholder considerations. Point 10 asks about cost analysis and accounting controls. Does management have detailed systems for understanding every aspect of the business? Point 11 examines competitive advantages in the industry. What unique aspects of the business give it an edge over competitors? Point 12 looks at long-term profit outlook. Does the company have a short-term or long-term outlook regarding profits? Point 13 considers dilution. Will future growth require enough equity financing that current shareholders will see their ownership significantly reduced? Point 14 addresses management integrity. Does management talk freely to investors about problems as well as successes? Point 15 asks whether management demonstrates unquestionable integrity. These 15 points form a comprehensive framework. But how do you actually gather this information? This brings us to Fisher's second major contribution, the scuttlebutt method. Scuttlebutt is an old naval term meaning gossip or rumors. Fisher adapted it to mean systematic intelligence gathering about a company. The idea is simple but powerful. You learn more about a company by talking to people who know it well than by reading annual reports alone. Fisher recommends talking to multiple sources. Speak with the company's customers. They can tell you whether the product is truly superior and whether the company delivers on its promises. Talk to suppliers and vendors. They understand the company's payment practices and purchasing behavior. Interview competitors. They often provide honest assessments of a company's strengths and weaknesses. Speak with former employees. They can share insights about management quality and corporate culture. Consult with industry experts and trade association members. They understand broader market trends and competitive dynamics. The key to scuttlebutt is triangulation. You gather information from multiple sources and look for consistent patterns. If everyone says the same thing about management quality or product superiority, you can have confidence in that assessment. Fisher also emphasizes speaking with the company's management directly. Ask tough questions. Observe how executives respond. Do they answer honestly and thoroughly, or do they evade difficult topics? This research process takes time and effort, but Fisher argues it is worth it. When you truly understand a business, you can invest with conviction. You will not panic and sell at the first market downturn because you know the underlying business remains strong. Now, let us turn to what Fisher considers the most important factor in any investment decision: management quality. Fisher believes that management matters more than any other single factor. The best business opportunity means nothing if management cannot execute effectively. What makes management outstanding? Fisher identifies several key traits. First, management must be honest and forthright. They should communicate openly with shareholders about both successes and challenges. Second, management must focus on long-term value creation rather than short-term stock price movements. They should make decisions that benefit the business over many years, not just the next quarter. Third, management must demonstrate operational excellence. They should understand every aspect of their business and continuously work to improve efficiency. Fisher also emphasizes the importance of management's treatment of investors. Does management act as a steward of shareholder capital, or do they enrich themselves at shareholder expense? Look at executive compensation, stock option grants, and related party transactions. The best management teams align their interests with shareholders. Understanding management requires more than reading proxy statements. It requires observation over time. How does management respond to adversity? Do they admit mistakes and learn from them? Do they promote from within and develop talent? These questions reveal character and capability. Fisher's philosophy naturally leads to his views on when to buy and sell. His approach differs dramatically from conventional wisdom. Most investment advice focuses on market timing and trading strategies. Fisher rejects this approach entirely. He argues that if you have done your research properly and found a truly outstanding company, the best strategy is simple: buy it and hold it indefinitely. Fisher popularized the concept of buying and holding for the very long term. He believed that selling a great company simply because its stock price has risen is a mistake. Outstanding businesses compound value over decades. Every time you sell and buy something else, you incur taxes and risk making a poor decision on your next investment. This raises an important question. Which of these principles, the systematic checklist, the scuttlebutt research, or the focus on management quality, do you find the most challenging to apply in your own investment approach? Fisher does identify 3 situations when selling is appropriate. First, sell if you made a mistake in your original analysis. If the company is not as strong as you initially believed, admit the error and move on. Second, sell if the company's fundamentals deteriorate. If management quality declines, competitive advantages erode, or growth prospects disappear, it is time to exit. Third, sell if you find a significantly better opportunity. But this bar should be very high. The new investment must be clearly superior to justify the costs and risks of switching. Notice what is not on this list. You should not sell because the stock price has gone up. You should not sell because you think the market might decline. You should not sell because you have held the investment for a certain period of time. These are all poor reasons to abandon an outstanding business. Fisher's philosophy extends to portfolio construction as well. He advocates concentration over diversification. Most investment advisors recommend owning dozens of stocks to reduce risk. Fisher disagrees. He argues that if you have done thorough research and found truly exceptional companies, you should invest significant capital in them. Owning too many stocks means you cannot know each business deeply. It also dilutes the impact of your best ideas. Fisher suggests that a portfolio of 10 to 12 carefully selected stocks provides adequate diversification for most investors. Each position should be large enough to matter. This concentrated approach requires confidence in your research. It also requires emotional discipline. When one of your holdings declines, You must trust your analysis rather than panic. The final element of Fisher's philosophy concerns valuation and timing. Fisher is primarily focused on finding quality growth companies, but he also understands that price matters. Even the best business can be a poor investment if you pay too much for it. Fisher recommends buying during periods when the stock is out of favor or undervalued relative to its long-term potential. This might occur during general market declines, temporary business setbacks, or periods when the market is focused elsewhere. However, Fisher warns against waiting too long for the perfect price. If you have found an exceptional company and the price is reasonable, it is better to buy now than to risk missing the opportunity entirely. The difference between paying 15 times earnings and 18 times earnings will matter little over a 20-year holding period if the company grows as expected. The power of Fisher's approach lies in its simplicity and logic. By focusing on business quality, doing thorough research, and holding for the long term, investors can achieve uncommon profits with acceptable risk. This strategy requires patience, discipline, and independent thinking. It means ignoring most market noise and short-term price fluctuations. It means doing real work to understand businesses deeply. Fisher's influence on modern investing cannot be overstated. His emphasis on growth, quality, and long-term holding helped shape the strategies of some of history's most successful investors. Warren Buffett combined Fisher's growth focus with Benjamin Graham's value principles to create his own approach. Other legendary investors, from Peter Lynch to Charlie Munger, have acknowledged Fisher's influence on their thinking. Common Stocks and Uncommon Profits remains relevant today because its principles are timeless. Markets change, industries evolve, and technologies advance. But the characteristics of outstanding businesses remain constant. Strong management, competitive advantages, growth potential, and shareholder-friendly practices will always create value. The key insight from Philip Fisher is this: wealth in the stock market is not built through constant trading or following hot tips. It is built by finding exceptional companies, understanding them thoroughly, and allowing them to compound value over many years. That is how common stocks produce uncommon profits. If you found this summary valuable, make sure to subscribe to this channel. We upload one high-quality book summary every single day to help you learn faster and invest smarter. And if this video helped clarify Fisher's investment philosophy, consider giving it a like. Your feedback helps us understand which summaries provide the most value. Thank you for watching.